I had a tree down because of the storm on my house, and the workers that came to remove the tree were like, "Can you teach me how to trade?" Okay, it just goes on and on and on. And so it's never been more popular than it is now. But the evolution of that is, so I started, my goal was to always be on the cutting edge of what's working. And so when I first started doing options, I started with one strategy, which was credit spreads. Now, the beauty of credit spreads, and let me just show it to you really quickly, is that they're built to win. So let's take an example right now of Uber. Uber's been weak on earnings. It's trading lower. So we think it's going to stay down. We could go out to August 21st and we could say, I think it's going to stay below 33. It's at 31.70 over the next 2 weeks. It's not going to go up $1.30. So we could sell the 33 call, and you see at the bottom right here, we'll sell one of the 33 call for 57 cents. And here's how it works. If Uber stays below 33 over the next 2 weeks, I make $57 on one contract. That's not exciting, right? If I do 10 contracts, I make $570. Okay. But if Uber goes above 33, then I'm going to be shorted, right? And then I could have unlimited exposure, which a lot of people don't like. So instead of just selling the 33, what I would do is buy. So right now, you see the max loss, it's infinite. Both Steve and myself never want you to be in situations where you have infinite exposure. You know, if you own a stock, your worst case is zero. That's not scary. Being short a stock, and that's the whole reason Kodak had gone up, is scary because the place where it can go is infinity. So we're going to take this 33 call, and then we're going to buy a 35 call for protection. Okay. So instead of making $580, our credit's only going to be $400. So we lowered our profit by $180 to $400, but we took our exposure from infinite to a $2 spread, less the 40 cents. So our risk would just be $1.60 or $1,600. So instead of risking infinite amounts to make $580, you risk $1,600 to make $400. So we would make 25% on our money if in the next 2 weeks Uber stayed below 33. The most we could lose is $1,600. The probability of a profit is 80%. Okay? That's why I always teach this strategy first, because there's so many people making so many promises out there. I want to come out and show people a strategy that's built to win and that will have a high degree of success. Okay? All right. You got it? We want to show people the best way to succeed in trading. Okay? And so credit spreads is going to give you a chance to win. And my belief was if I could bring people in and I could show them the right way to trade, then they'll feel comfortable moving forward with us. And Steve, just in terms of credit spreads, is there anything you want to add?
I would say the main thing is the concept behind them is you don't necessarily need to be right to profit. So you find a level, and whether it's a bull or bear, you know, a bull put spread or bear call spread, you don't necessarily need to be right or have a big move to profit. And that goes into the probability of profitability, that, you know, you can have something that actually might go slightly against you and you still make money. And that's a nice feature. So I would say that's part of like understanding how to use options and the pricing of options in your favor, and not use them as simply lottery tickets to say, I think everything's going to the moon. And that's your step towards being whether you want to call it a professional or somebody who's an educated user of options.
Okay, so right, and the reason, uh, okay, the reason why we started with that was because of the very high degree of win rate, which is you could put on trades with a 70 or 80% chance to win. Okay, so that's what credit spreads are. They're bull put, bear call, defined risk trades, high probability success. So I started doing that for a couple of years, right? And no, Lee, you're only liable for the difference. So your risk is capped at the spread minus the credit you collected. Okay, so we started with that, and we ran that for a couple of years, and then people started saying, well, there's two things I would want more. I would want to be able to have bigger gains, because when you put on that credit spread, the most you can make is that credit you accept at the beginning. So people said, I want to be able to make more money. How do I make more money? And also, I don't want to spend as much time doing it, right? That's the beauty of trading. And I'll tell you, I had never joined a country club before. I wasn't into golf. But after the coronavirus and everything, I spent so much time inside. I was like, I think I'm gonna start playing golf. So I joined a country club this summer, Steve, a couple months ago. And the correlation between the number of people that are in finance, trading, or real estate and play golf is like 99%. Everyone, you get to the tee, you know, what do you do? I'm involved in the stock market. I'm involved in real estate, right? And the whole reason is because your time doesn't correlate with your money. And that's what people were asking for with this second strategy, which was the diagonals. They wanted to be able to make more money and spend less time doing it. And so that's the strategy I was going over to begin with, which was that Cisco example. So what you're going to do with the diagonals, you're going to buy either a stock if you're doing a covered call, or you're going to buy a long dated call further out in time. Okay. So in this example, and here, let me just, this one's a little easier to show with the portfolio manager, just because, and I could show you the making of the trade, but here, let me just, actually, you know what? Let me build the trade first, and then I'll show you the example, just so you see it, okay? So let's take Beyond Meat, right? Beyond Meat's actually having a wild day today. It opened at 132, high of 132.57, low of 124, and now it's trading at 126. But let's say we think Beyond Meat's going to be at 150 by September, and that's not impossible in this market. Okay, so if we're doing a diagonal calendar, typically what we're going to do is we're going to put on the initial strike at the money. Now, at the money means as close to the price that the stock is trading at. So if the stock is trading at $127, we're going to go and we're going to say, okay, in September, we probably go, maybe even go a little bit further out. Let's go to October. And usually when you're buying the long dated call or put for a diagonal calendar, you want to go, you know, at the what's called the monthly option. That's the third week of every month is the monthly. Those are the more popular options. Most options have weeklies now, but the monthly is the most popular when you're going further out in time. So if we want to buy the 125 call, and why 125? Because the stock's trading at 127. We want to go as close to it as we can. So look, here are our choices. 120, that's 6 points away. 130, that's 3 points away. Or 125, that's $1.70 away. And typically when you're buying your further out in time stock, you want to go away from the 30 delta. Delta is the rate of change. So at the 30 delta is going to be down here. Away from the 30 delta is either going to be up here, which is really deep in the money, or over here, which is at the money. Okay, so, or you could go the other way, which would be under it further out, but that's a very low probability trade. So we're going to go at the money, 57 delta, by the 125 call. Okay, no problem. Now, the expected move in that time is $24. But that's the thing, it's not going to get there right away. So we're going out till October 16th. What we're then going to do is we're going to sell next week's 130 call, which is 5 points away. Because what's the expected move for next week? 10 points. So maybe we would even probably do 130 because we'll be able to roll that. Okay. So instead of spending $14, it gets it to 10. And by the way, when we sell options, actually, you know what? Let's do this by the book. I'm going to give you a by the book example. Okay. We're buying October 16th, 25 call. And right now our profit's unlimited and our risk is 1465. Okay. But now we're going to go out and we're going to sell the weekly August 21st. And we want to go, when you're selling premium to collect money, you typically want to sell at the 30 delta, which would be over here, 135. Now, why the 30 delta? Okay. Well, the expected move in the stock in the corner is $10. It's trading around 125. So that would go to 135. So we want to sell it where we think it will stop. Okay. Now, we could factor in some other things. Are we bullish this stock or are we bearish this stock? Or are we a little bit short-term bearish because the momentum, but long-term bullish? And in this case, we're a little bit short-term bearish, but we're long-term bullish because we think over time this is going to go up. So instead of going at the 30 delta, we're now factoring in our outlook that we're a little bit bearish right now, but we'll be more bullish down the road. So we're going to bump this up a little bit and maybe go to the 132. So we'll give it 7 points. Okay. So we'll sell the weekly August 21st for 350. Immediately, we brought our cost basis down from $14 to 11. So our risk went from 1,400 to 1,100. Okay. But here's the best part. And this is why I'm obsessed with this strategy. This is $3.50 for 1 week. You have 2 weeks in August. Okay. Then you have 1, 2, 3, 4 weeks in September is 6, and then 3 more weeks in October, which is 9. Okay. If you multiply 9 times an average premium collection of $3.50 a week, it's going to be, here, let me do it. There you go. Right? So it's important that you see this. So the cost for the initial option was $14. The weekly collection is $350. If we can average $350 a week times the 9 weeks that we're in it, $350 times 9 would be $31.50. Okay. So if Beyond Meat goes nowhere, but we collect $3.50 a week, we're going to make $31.50, and we're going to lose the 14 that we bought as our anchor, which means we're going to make $17.50. Okay. That means Beyond Meat can go nowhere or go down, and we're going to make 100% on our money just because of the premium collection component. All right. Now, it's great to say in theory we could average $3.50 a week, but it's better even so to show you how you're doing that. Okay. So when you go to the options wealth machine and you look at these trades, this is that theory in action. Okay. This is Snapchat. So Snapchat, we bought the 24 calls. The stock's gone down $3. 24 calls going out to August and June cost $2.44. 244 times 2 contracts equals $488. Okay. That's the total risk on this trade was $488. Our close profit on this trade is $552. So even though Snap has gone down 3 points, we're profitable no matter what. We own these options at 0 cost. We could only make money in this trade. When you look at Uber, the initial cost on this trade was $3.05. We put it on July 16th. It goes till September. We've already collected, so $3.05 times 4 is $1,200 risk. We already closed $744 in profits right? Which means we only have $450 in risk left. The trade's going our way. And guess what? It's August right now. We get to be in this trade for 5 more weeks of premium collection. So no matter what, it's going to be a winner. So that was the advancement. That was the evolution, how we went from credit spreads to diagonal calendars. Okay.